Hey everyone, in this video, we're going to talk about how you can use a hard money loan to do the BRRRR strategy so you can acquire more properties for your rental portfolio. My name is Sean and I'm a hard money lender and real estate investor based here in the Bay Area. And on this channel, we go over real estate investing tips, strategies, and current events to help you learn more about the business and to help you become a real estate investing boss. So in today's video, I want to answer one of the most requested questions that I've gotten on my channel, and that is how you can use hard money loans to help you acquire more rental properties. And before, this was always a challenge because traditionally hard money loans are these short-term interest-only loans that are due within 12 months or so. And if you're going to hold onto a property as a rental, typically you want a longer loan duration. You want something that's 15 or 30 years that you can pay off over time. Well, recently we've actually created this long-term rental program, and if you guys want to know more information about it, I created a video about it right over here. But the beauty of using a long-term rental loan is that we give you the loan based on the income that the unit itself produces versus your own income from your job and whatnot. So this is great for real estate investors who may have too many properties and too many loans already and can't get traditional financing, or for entrepreneurs who just don't have that normal W-2 salary that banks like to see. So this is an option for them if they want to buy some rental properties. But some of the downsides with our long-term rental loan program is that one, they are slower to close. So if you're trying to get a great deal off market that needs to close quickly, this is not the product for you. And two, we can't lend on properties that need rehab work. These need to be rent ready by day one. So what we can do is we can actually help you buy the property using a short-term bridge loan and then converting it into a long-term rental loan. And by doing it in this method, you're able to buy a property for a very low price, do the rehab work, hold it for a little bit, and then do a cash out refinance to bring out most of your money back. And this is known as the BRRRR method, where you buy a property, you renovate it, you rent it out, and then you refinance to get all your capital back out. So we're going to do a quick case study to see how that would look like on paper. Okay, so now we're here on the screen. So let's imagine that you have a property that you can acquire for $200,000. And after you renovate it, it's going to be worth $300,000. And let's assume that the renovations take around $30,000 to do. Now, you probably can't get a deal like this in the Bay Area, but you can certainly find deals like this in other places like in Fresno or maybe in the East Coast. Now, let's assume that when you're buying the property using a hard money loan, you're going to get it at 80% LTV. So that means that your loan to value ratio is at 80%, and we're going to give you a loan for 80% of the purchase price. If we do it like this, traditionally our rates are going to be around 10%, and our origination fee is going to be 1 point. So that means that you're going to be paying 10% on the loan amount on a yearly basis, and then we charge you 1% the loan amount as origination fees right up front. Now, we traditionally charge a $1,500 processing fee, but since you guys are viewers of the channel, we can discount that to $9.99. So if you want to see how much you need to actually fund this deal, if we have it at 80% LTV, that means that your loan amount is going to be at $160,000. Which means that your down payment will be $40,000. Your rehab costs, as we set up here, is $30,000. Your origination is going to be 1% of your loan amount. And if you hold it for 6 months, the amount that you have to pay in interest is $8,000. So I got this by calculating the loan amount multiplied by the interest rate and then divided by 2 because it's half the year. Now again, you can always do this faster, and if you plan on selling the property, then your interest rate will be a lot lower. But we're considering the scenario where you're holding onto the property to then refinance into a long-term rental loan. So that means that your cash in the deal is going to be equal to the sum of all of these right here. This is all the money that you put into this deal. So around $80,000. And you also have a loan for $160,000 that you need to pay off. So if you hold onto the property for 6 months, we can actually do a cash out refinance using the full value of the property itself. So if the ARV is going to be $300,000, then we can use 70% of that number to give you your cash out refinance. So let's see how this is done. The first thing we're gonna do is find out how much the property can rent for. We're gonna calculate the mortgage payments, including principal and interest, and that'll be determined by our rate sheet that we'll show you in a little bit. We're gonna find out what the insurance and tax payments and association dues are so that we can calculate our total PITIA. And that stands for principal, interest, taxes, insurance, and association dues. This is gonna help us determine, called the DSCR, also known as the debt service coverage ratio. for this loan, we need the DSCR to be above a certain percentage in order for you to qualify for this loan. So let's assume here that the rent is for $3,000. We'll calculate the mortgage in a little bit because we need to find out what our interest rate is going to be. Let's assume that insurance is going to be $700 per year. And then let's assume that taxes are going to be $4,800 per year as well. Now, if we divide that by 12 to find out how much they actually are for the month, we can see that we have around $60 for insurance, and we have $400 a month in taxes. Let's assume that this is a single family home with no HOA dues, so it's 0 here. Okay, so let's go ahead and calculate the interest rate. So to calculate the interest rate, we actually use a nice sheet right here that kind of tells us the breakdown of what we can give you. So in general, the higher the credit score you have, the better it's going to be for you. The lowest credit score that we can use for this program is 660. Let's assume that you have a 760 credit score and you're trying to do a 75% cash out refinance. So what we would do here is we would take this base rate here of 5.625 and we'll put it right here. So base rate, 5.625. The next thing we're going to look at is down here for all these additional adders. So we don't know if this property hits a 1 DSCR or a 1.15 DSCR, but as you can see here, for 75% LTV, we're actually not doing 1 to 1.15 DSCR. It has to hit above a 1.15 DSCR in order for us to qualify for this loan. The loan balance is above 100,000, so we don't need to worry about this. And we are doing a cash out, so we do have to add 0.5% for the rate. This is a single family home, so this is not an unwarrantable condo, and this is not a 2 to 4 unit property. And for this case, let's say that we don't mind holding on to this property for a very long time. So we do want a lower rate, and we don't mind that we have a 5-year prepayment penalty. So the way that prepayment penalties work for the long-term rental program, it's a step-down method. So if I go for a 5-year prepayment penalty and I sell on year 1, then I have to pay 5% of the loan amount as a prepayment penalty when I close on my property. Now, if I wait for the next year, then it's only 4%, next year 3%, 2, 1, and then no more. Some people don't want prepayment penalties. The best we can do right now is a 1-year prepayment penalty. So that means that if you sell your property within 1 year, then you pay 1% of the loan amount. But by doing that, you actually increase your yearly rate by 0.5%. So it really depends on what your strategy is and how long you plan on holding onto this property. Again, we plan on holding onto this for as long as we can. We have no intention of selling or refinancing. So we're going to use a 5-year PPP. So we're going to reduce our rate by minus 0.25. So 5-year PPP. Okay, so our sum is going to be equal to all of this. And we see that our rate for this loan is a 5.875. Now this number might not be as low as you expected, considering that interest rates are at almost all-time lows. But remember, this loan is for people who can't qualify for traditional financing anyway. So to them, this is a great opportunity, because if you go with a private lender, they'll probably charge you 10 or 12%. Okay, so now that we have the rate that we're gonna go for, let's see if we can actually cash flow. So the way we're gonna do it is calculate how much we have to pay on a monthly basis for our mortgage. Let's write out how much we're actually trying to get for our loan amount. In our case, we're trying to do a cash out refinance for 75% of our ARV. So that's 75% times 300,000. So that loan is 225. So the way that we calculate our mortgage is very simple. We just press enter and we use this very simple formula, minus PMT. We use the rate. Remember to divide this one by 100 because this is a percentage. And then divide it by 12 because that's how much we're doing on a monthly basis. Press comma and add in how many periods are we going to do. In our case, it's 360 loan payments because that's 12 months times 30 years. And then we're going to add in the loan amount as our final number. And boom, our mortgage payments are going to be $1,330 every single month. And that includes your interest and principal payments. So let's add in our total PITIA. So that's our mortgage plus our insurance per month plus our taxes per month. And again, we have no association dues on this property. So every month we're spending $1,789. Now if we assume that rent was for $3,000, then our DSCR or debt service coverage ratio is going to be equal to the rent divided by the total PITI. And that's 1.6. So it's way far and above our 1.15 percentage that we needed. So what we can do now is we can go back to our rate sheet actually and see that if you have above a 1.15 DSCR, you actually get minus 125 on your rates. So we can do DSCR bonus minus 0.125, and then see here that it adjusted to 5.75, and now our mortgage payment dropped by about $20. So overall, not too bad. Our DSCR went up even more. And you know, this rent is kind of high. So what if the rent was only for $2,000? Then it wouldn't qualify for our current loan because we do need a DSCR above 1.15, which is basically 115%. And as you can see here, for a 1 to 1.15, we cannot do it for 75% LTV. So we need to reduce something or increase the rents by just a little bit. So maybe even if it's at 2,100, then it increases the DSCR. So you see here, you have to actually play with the numbers and make sure that your plan makes sense before you execute and just try to jump into this without thinking. But by doing this, you actually now have a loan for $225,000. If we look at how much money you actually owe on the deal, let's say your loan, total money in is equal to your $80,000 that you put into the deal plus your loan amount, and that's at $239,000. So overall, you still have about $15,000 stuck in the deal, but it's a lot better than having $80,000 stuck in the deal plus paying hard money costs. By doing this strategy, you're able to BRRRR properties, accumulate your wealth, and grow a huge portfolio of rental properties. Well, I hope you guys all enjoyed this demonstration of how you can use hard money loans to acquire and BRRRR properties. If you guys have any more questions about the process, feel free to contact me. You can find my contact information down in the description below. And of course, because we do the hard money bridge loans and the LTR loans, we can even give you guys a discount if you decide to do both on a project. If you guys enjoyed this video, be sure to smash the like button, subscribe to the channel, and hit the bell notification to see more videos just like this one. Thanks for watching, guys, and I'll see you next time. Take care.